Good morning, everybody. Uneducated Economist here. So I got a couple of articles I want to share down in the description for you guys, talking about the U.S. Treasury yields. And one of the articles is talking about how Treasury yields have to rise in order to attract foreign investment. And the other article is talking about how Treasury yields, or at least Treasury bills, which is the short-term Treasuries, have gone to zero. Now, what seems to be like contradictory articles really are talking about two different things on two different timelines. And I really feel that one of them is going to lead into the other. So if you look at the article talking about how Treasury yields need to rise in order to attract foreign investment, really, I don't think it's just necessarily foreign investment, but investment in general. And the idea is that right now, the perception that inflation, price inflation, coming into the future is going to run rampant, right? Everybody is just like screaming inflation, inflation, inflation. And if the investor has this perception that there's going to be inflation coming into the future, then they're going to want a higher return for tying up their money for a period of time. So this is the idea where yields need to rise on the treasuries in order to attract the investment, which makes a lot of sense. Now, of course, we got like central banks kind of obscuring everything with their asset purchases, but really that's the idea behind it is that if the investor is not there to buy those bonds, then the price of them will begin to fall and the yields will begin to rise until the investor is finally like, well, I'm in. I'll buy it for that. Now, the other article is talking about how treasury yields or the bills have gone to zero. Now, this is pretty interesting because really it's talking more about how the cash drawdown coming from the treasury is causing the Treasury to issue out less short-term Treasury bills. So I should probably step it back a little bit. During the pandemic, the Treasury and the Federal Reserve had, in conjunction with each other, set up these lending facilities and stimulus programs in order to support households and businesses. At least that's what they said. A lot of this money wasn't used and it was returned back to the Treasury. The Treasury is now sitting on a lot of this cash and they're trying to draw it down. It was like over $1 trillion. And they've already drawn down like quite a few hundred billion, 400 or 500 billion, and they want to do like another 400 or 500 billion to get it back down to what would be more of an appropriate normal level. I believe this also has something to do with the debt ceiling and budget debates or something. Anyway, I should have probably looked that up before I started the video. But anyway, they need to bring this cash down to a more appropriate level, which is another 400 or 500 billion dollars away, which means that there's going to be less treasury issuance. And if there's less treasury issuance and you have a demand for them and there's less supply, then the prices of them drop, the prices of them rise and the yields on them drop down to zero, which is what we have going on right now due to this lack of issuance coming from the treasury. This is a problem for the money market funds. And now what I found interesting is there's a huge inflow of cash rolling into these money market funds right now. And money market funds is the closest place to cash that an investor can be without actually having to hold cash. But these money market funds, they need to do something with that cash. They need to put it somewhere, and generally they put it into short-term treasuries. Money market funds, now if you remember, let me kind of take it back. Money market funds are what caused the great financial crisis. It wasn't what caused it, it's what set off the alarm bells first. When money market funds started having major outflows coming from it. This is a problem because money market funds is where like all financing begins. Like the financial system is like kind of centered down at the money market funds. It's where the short-term lending begins. After that, it starts getting, longer and deeper and more extensive. But when money markets begin to freeze, then the rest of the financial markets begin to freeze. So it's really important to keep these money markets flowing. Now, if the money market funds are in a position in which they have no place to go with their cash, then they start to shut down. And that's already occurred. We found, I was doing videos about that a while back, where a lot of these money market funds are just simply like, hey guys, these interest rates are just so low. It's too hard to do this anymore. We've waived like all our fees. We're done. We're like, we don't even want to operate anymore. So that can create an issue throughout the rest of the financial markets. And we did also experience a moment where a lot of cash rolled into these money market funds. They had no place to go with it. And the Federal Reserve had to do a repo, much like the reverse repo that happened back when they did like basically the non-QE is what a lot of people were referring to it as. And this is where the Federal Reserve was going to the banks and handing them cash and taking treasuries off their balance sheet on an overnight basis, and this rolling this over. That way they were providing plenty of liquidity to the banking system. Now, the repo, on the other hand, works exactly opposite. These money market funds are sitting on all this cash and need a place to go with it, and the Federal Reserve is handing them treasuries and taking cash off their balance sheet, so they can do this on an overnight basis. Now, if you think about it, if the reverse repo was a form of quantitative easing, then the repo is a form of quantitative tightening. And this is a problem, because once the Federal Reserve is engaged in this is like almost, I don't know if it's necessarily like an emergency act, but it's more of like, it's like a temporary, it's a temporary solution to market imbalances, I guess is the easiest way to describe it. That's what the repo market was supposed to be about. But when it turns into a standard everyday practice, that's an issue. And the Federal Reserve knows this. And now right now we have a lot of cash rolling into these money market funds, and I'll leave a link down in the description to an article for that. And already you're starting to see the Federal Reserve talking about tapering. Because at some point, if these money market funds are sitting in a position in which they have no place to go with their cash, and the Federal Reserve is sitting in a repo market trying to deal with this, which is not really something that they should be doing on a regular basis, but just a temporary one, then the Federal Reserve may have to say, you know what, guys, we may have to back off on some of our quantitative easing to provide more treasuries to the market. Now, they may not even be participating in the short-term treasuries. Like, they can say, hey, we're just going to back out of the short-term treasuries altogether to give the money markets plenty of, supply, but it may not be enough. And so what they would have to do is actually change the market perception. And once that happens, now you've reversed course. So, and I'll leave links down in the description for all that stuff. And that's what I feel is probably going to end up taking place going into the future at some point. Now, how long the course of time that goes on, I don't know. But that's really seems to be the logical thing that I'm coming up with, is that these interest rates are going to be so low, money market funds are going to start freezing up, there's going to be imbalances in the financial system, and the Federal Reserve is going to have to say, you know what, we're backing out. We're going to have to back out on this because obviously our quantitative easing is no longer needed. And once that happens, people are going to be like, whoa, if they're done, we're done. Anyway, thought I'd share that one with you this morning. All right, Uneducated Economist, you guys let me know. You want to take a walk out to the river real quick? Let's do that. I got a little bit of time before I gotta go to work. Oops. Let's just take a quick walk down here, guys. You guys have a great morning. Uneducated Economist, you let me know.